I want to start with just a word of gratitude, and I want to say thank you. Thank you for your years of service to me, my family, my people in my church, my community, and my world, both the ministers, the lay who've worked in the church, and their spouses. Thank you. I want to start with that because I know you have not had an easy job, and you've made me a better person. So a little bit about me when I start. I'm wearing sunglasses not because I want to be a movie star, but I have something wrong with me called blepharospasm, and these fluorescent lights make my eyes close or start to blink, so I'll wear my sunglasses on and off. Sometimes when I start talking and moving around, I won't need them, but if I do, they'll stay on. Taxes. We'll start with the most probably boring but kind of important in retirement. To start with, you ministers are complicated as far as taxes. So before I go anywhere with the next slide, seek advice and planning. Seek advice and planning. You need to find a professional who knows how to do ministers' tax returns. John comes to me with war stories of people who are professionals who have not done the tax returns correctly, or churches who have not done the W-2s correctly. So seek help. And planning is so important. John has already mentioned that. I'm sure all the other speakers have mentioned that, because your age, what will happen to your Social Security in the future if you let it sit, what are your taxes going to be? Should you draw more money this year or next year? So these are the things I kind of want to go over. If we were looking just from a pure number crunching way, which is what I do most days, you would want to maximize your income and keep your taxes low. Now that might not fit with the investment side. You know, you may want to leave it in West Path and not pull it out. But if you can maximize that income or that flow of income, even if you're not going to use it, and go ahead and pay the taxes on it, because most of the retirement is deferred for most of us, unless you paid taxes before. All of the monies you received in your job and not out of your salary are deferred. And most of us deferred what we paid in also. So you want to maximize that, but keep the taxes low. Now, ministers are unique. You get an exemption for your housing, even when you're retired. And you don't have to pay Social Security on it like you do when you're a working minister. So we're going to go over that and how to cover your taxes. You already have this issue. Do you do estimated tax payments, or do you have withholding, or do you have a combination? We're going to find out some of the items you're going to receive you don't think of as income. You may need to have withholding or increase your estimated tax payments. And how will large withdrawals affect your tax liability? Because the rates are different. So there again, that's where you need to seek advice and do some calculations. And should you pay off home or debts? Someone had a question, rent versus buy your home. And there was a change last year to moving expenses, so I just want to go over that again. All right. First of all, you need to meet with your tax advisor and your financial professional so you can kind of know where you are, because laws, as we just saw last year for 2018, and circumstances do change. You need to know your sources of income and what your needs are going to be over the next few years and what year you're going to start Social Security. Now, you had pretty good, exciting Social Security presentation, and there are special rules with Social Security. I won't try to delve into those too deeply. You need to know your deductions. Now, I have exemptions up here, but last year the exemptions went bye-bye in 2018, and I have a schedule to show you that. So now we just have a standard deduction with no exemptions. And this is the part that hits people pretty hard. Your Social Security could be taxable. You may be taxable at 50% or 85% over thresholds, and it depends on if you're single or married. And then some deductions may have limitations or requirements. Most people we're seeing today, because we lost the exemptions and we increased the standard deductions, we do not see as many people itemizing. So that fits for most everyone. So a little bit about me before we go to the next slide. I've been at the foundation for 20 years almost in next May, and I taught school for 6 years. I was a math and science teacher, and then last year of college, I went to Florida Southern, the good Methodist college, and I took my first accounting course. Of course, that was exciting to me. I really enjoyed it. My chemistry professor kept trying to tell me, oh, you won't like that, it'll be so boring. But I went back to school at night and picked up the accounting and became a certified public accountant and worked at public accounting for 12 years. And I left about 12 to 14. I left there and I went to the community mental health service because always with accounting, I have a heart for people. And in our local area, it's called Peace River Center. So I was the CFO at Peace River Center for 6 years before I think God called me to the foundation. And I've been there for 20 years, and it's been a good fit. And I'll tell you one thing I love about the foundation is the people at the foundation are for the churches and the people of the churches. And John has added another layer of helping the ministers in the churches, which has also been exciting to see. So that's a little bit about me and how I got to be here. I was the treasurer, but now I'm the vice president. I got a title increase, but I really love to crunch the numbers, I'll be honest. So let's go over a couple of things. I wanted to show an example of why you need to seek advice. And just realize that my advice is not advice, it's just trying to get you to start thinking about it. Some of you may or may not own homes. How many people own a home? How many own 2 homes maybe? You've been to 2 appointments, so you got 2 homes. The IRS and the government in our tax laws has increased how much you can exclude from the gain of a home. For singles, it's $250. It's $500. Now that's the gain. So if you paid $150,000 for a home and you sold it for $400, that would be $250 that you would be excluding. But you have to meet certain rules. You have to use the home for at least 2 of 5 years, but they don't have to be continuous. So you might have used it 6 months and then used it 18 months. And if you didn't use it the whole time, there may still be some exclusions in the calculations. There again, that's where it gets more complicated, and you should probably seek the advice because there's a schedule that has to be done. Exclusions may not be claimed for more than one sale or exchange during any 2-year period. So say you had those 2 homes and you're wanting to sell both of those homes. Well, maybe you need to wait on selling the second home, make it your personal residence for a while, so you meet the 2 of the 5 years, and then you wait 2 years to sell that second home because you can get the exclusion on the second home. This is where you really need to seek advice and do some planning. So don't just go out there and sell the home, because if it's over that or you can't exclude it, you're going to pay taxes on it. Whether it's 10 or 32%, I'm just doing a range, you're going to lose some of that gain on the home by having to pay taxes on it. By excluding it, you will not have to pay taxes on that sale of the gain. So the requirements have changed under the tax laws from when I started doing public accounting, which was 1983. And they've increased the dollar amount, so we anticipate at some point they'll probably increase it again. There's a publication you can go to, which I've listed the website. And here's another issue, because I can see this happening knowing ministers. You may have a home in one town and you go to another town. So you keep that home, but you rent it out. Or maybe you can claim part of it for business usage, but I'm saying rental for most of you. There are some special rules for that that will allow you to use that exclusion still. And I've listed some of the rules, but there again, that's where you need to sit down with an advisor and lay out what you know about your situation and your circumstances. Some of these rules are the space was not used for rental or business when sold. You had no rental income in that year, and it was a residence. You still got to meet that 2 of 5 years. If the space was considered a residence when sold, former business uses does not affect the gain or loss. Now, always, I will tell you this, with rental property and business usage, you may have depreciation, and you may have some depreciation recapture when you fill out the form. And that may be an issue, but for the most part, there are some guidelines to help you figure out how to exclude that you would want to make sure you were able to do. Make it your residence, 2 out of the 5 years, not be renting it the last year you sold it, and no rental income. So there are some special rules with that. So that's where you would seek advice from someone. Hey, I'm planning to sell my house in a couple years. What do I need to do to make this excluded? Or I'm going to sell 2 houses. I don't know when, but how am I going to exclude it? All right, now a lot of this you already went over with Social Security, but I'm still going to kind of go over it a little bit. You can retire between 62 and full retirement age, as you already know. Some people can even receive benefits at 60 if they're spousal widow benefits. You can start early, but there are fractions, and I've listed where the table is on the Social Security website that shows you what they are. And the next slide is a table on some of those items. So you select your birth year. We had an employee whose birthday is January 1st. Well, if your birthday is January 1st, you go to the prior year. In other words, people whose birthdays are January 1st, they actually get to retire early a little bit. Isn't that nice? So one of the benefits of being born on New Year's Eve. So this is the table that kind of lists the what they're going to keep from you if you start at 62 and not your normal retirement age. We talked a little bit about drawing on your spouse, and I'll just tell you a personal story. I was married about 8 years ago, and it's a second marriage for me and my husband, and he was a widower, and he had been married for 38 years. Well, he wanted to retire at 65, so lucky for me, I get the AARP news bulletin. I don't know if any of y'all received that. And I just was reading about it. Well, there's special rules in this situation. If he had gotten married he was past the age of 60, which he had. He didn't plan that. He had been married more than 10 years to a spouse. He was born before the 1954. He was allowed to draw on his spouse, and his money grew till he was 70. He let it grow till he was 70. Even that he was almost equal to his spouse, but then he was getting the 8% per year. So you who were born before 1954, which is not me, I'm close, but not there, you need to look at that and do some planning. I know you've been talking about it, but there's a case of maximizing your income in those years. Now, the thing you have to think about with Social Security, though, if you go out there and you read about it, the longer you work, they look back at so many years. So if you're making that higher income, that's also going to increase the amount you're going to draw from Social Security, because they're going to keep adding those years of the higher income versus the years 30 years ago, right? So that's another way it grows that you don't think about. You only think about that 8% per year past normal retirement age. But there are some ways it grows by continuing to work also. So you've probably been hit with this a lot already. All right, what about Medicare cost? The Medicare cost went up this year, $1.50, I think. It's $135.50 for Medicare. You can be charged a higher amount. And the bottom line tells you, they look back at your modified adjusted gross income from the past 2 years ago. So when you're looking at 2019, they're looking at the 2017. One of the things you can do, you might have been in a higher rate, a higher income at that time. So they're going to charge you more than the $135.50 if you're under certain ranges. And I gave you the location to go and look at that. So if you're in that group, but you're going to retire with less salary, you can notify them and let them know what your salaries are to get the lower rate. So make sure, you may have already heard that, but make sure you do that. Enroll in Part B, this is an issue too. Sometimes people think it said, okay, you didn't enroll, say you work past the 65, you should enroll in Part A at 65. I'm sure you've been told to do that. Part B, you may not enroll in because you're still working and you have health insurance. All they're looking for are you always covered? If you're not covered with health insurance, they can charge you a higher rate. So you need to make sure you're covered with insurance past 65, even if it's not Medicare, or they may charge you a higher rate. Are there any questions on that? Yes.
When you sign on to Medicare and you're with a current health care plan, do they enable you to keep that health care plan and not have to go to the marketplace? I'm just personal.
Yeah, I was in that situation.
Yeah.
In fact, I was under Nancy's plan under the conference.
Right.
And when I turned 65.
Right.
And I stayed on it.
Right.
Because at that time, it was costing me about $300 a month, which is about
Right.
the same for Part A and B. Right. And the only caveat I would give you, Wayne, was that when you do switch over to go to Medicare, there was a special form that you had to attest to the fact that you were covered and, show proof of insurance
Right.
that you had that other plan. But if I had to do it over again, I think I would have just switched to it when I was 65.
You would have just done what?
I would have just switched to Medicare when I was 65.
Oh, you did.
Even though the dollars were very similar. The reason I didn't do it, it was just easier to stay where it was.
Yeah, I was thinking about keeping your current doctors, like where we live, Tallahassee, there are not a lot of health care plans that are applicable there.
So the question was, if you turn 65, can you stay on your regular health plan insurance and not go on to Medicare? Yes, you can, but you should sign up for Part A. Do you disagree with me, John? You should sign up for Part A. And there are ways. Last year I looked into it for the foundation, because if you have less than 20 employees, and this may be something the churches need to look into. I haven't talked more to Lois about this, but you can do a health reimbursement plan, because we had an employee who wanted to go on Medicare, and my husband was eligible for Medicare, but he was on the plan of our plan. And I discovered you could do a health reimbursement account for less than 20, now if you had more than 20, and then you could help pay for the Medicare, and they could go on Medicare. The nice thing about Medicare, Wayne, is the rates are usually less for Medicare. So even if you go to your doctors, Medicare has contracted with the doctors for a lower rate, so you end up paying a lot less, even up to your deductible. Probably you noticed that too, didn't you? So there's savings, even though it might cost the same insurance-wise, there's savings, and the services covered may be even increased under Medicare.
There's one other thing I don't see up here that's important. When you're 65, there's actually a 7-month window when you can apply. it can only become effective on the first day of the month that you turn 65. But the 7 months in which you can apply are the 3 months preceding your birth month, and the 3 months after. You can do that without any kind of a penalty or any extra paperwork or anything. Most people don't realize they have that much flexibility.
So there was a comment that there's a 7-month window to apply for the Medicare at 65, the Part A, which that includes the hospital. That's the hospital. And it's considered primary before that other insurance usually. So there's 3 months before your birth month and then 3 months after. And it goes into effect the first day of your birth month. I would suggest all of you, if you're going to do anything with Medicare, to start 3 months ahead of time. Because the other thing I found is they do go back and pay you for 3 months prior to your birth month if you're going to make your retirement. Like mine would be 66 in 2 months. If I made that retirement and I did it 3 months ahead, they'll start paying me my Social Security 3 months ahead of that, or that has been their normal practice. Question?
My impression was it's required that you sign. Is that sign for Medicare? You have to sign up for Part A? No?
You don't have to, but it's highly recommended. That the question was,
So if you want to, then you've got that 7 months. And after that 7 months, there's a penalty.
right?
You might end up paying more.
And you might end up paying more. That's what I was trying to tell you when you were without insurance.
Essentially, the decision needs to be made now to 3 months before your 65th, because even if you decide later on down the road to sign up, that penalty's still attached to it, right?
It's really a no-brainer because they don't charge you anything for it. And it's called procrastination if you don't do it. So I would say you should do it. There's no cost for Part A. So they're not going to take any money from you or charge you any money for Part A. There are special rules with it, with the size of the employers too, with Medicare Part A.
And the other reason to, back to Wayne's question, if you, and like I did, where you keep another plan, and you have Part A, then you get into coordination of benefits if you did happen to have a hospitalization, and that gets complicated. So.
We had that with my husband. He had surgery. He had his hip replaced. Part A paid for almost all the hospital, and I sent him for 2 weeks to the nursing home, even though that probably was a mistake because he was calling me at all hours. But like 4 o'clock in the morning. But anyway, the insurance Part A paid almost all the hospitalization, but there are special rules on the size of the employer, so you have to know it's not one size fit all. There again, advice and planning and know what you have is very important. So basically, most of us in retirement are probably going to pay the $135.50. If not, it's going to be based on our income. And they're going to know what our income is from our tax returns. And they're going to charge us, and if we didn't pay enough in 1 year, they're going to go back and charge us. So it's going to get paid one way or the other. So there's no really free ride on the Medicare anymore either. They're going to look at your income. My father's friend, he won $50,000 gambling, and I think they hit him hard. He didn't realize that $50,000 was affecting his Medicare, and he ended up having to pay more money. Last year we had a change, and I have a little mistake right here. I think this should have been 2018. I'm not supposed to walk away, and I'll show you what 2019. We used to have exemptions for each person, and they kept going up every year, 3,400, 3,450. So you count the number of people there, and we had the standard deduction. But we had a tax law change, and you can see we went from $12,700 to $24,000 last year in 2018. Let's look at 2019. 2019, it's gone up $400. It's $24,400 for married. For head of household, it's $18,350, and married filing separately is half that $24,400, $12,200, and then singles are $12,200. in the third column is the amount we get if we're 65 or blind. So we get 1,600 extra if we're 65 added to that number for each, the person and the spouse. So you could get 3,200 if you're married. So those are some things to consider when you're looking at your itemized deductions, and we're going to go over a couple of those items. Are there any questions on that change and how the standard deduction works? So what it means for most of us, like I'll repeat again, is that you're not probably going to be able to itemize. It's just the reality. The tax law also broadened the lowered tax rates, not a whole lot. If you look and you see the 2017 was 10%, still at the bottom. It went from 15 to 12. There was a 3% decrease, 25 to 22, 28 to 24, 33 to 32, and then as you can see, it didn't lower a whole lot in each one of those brackets, but the brackets did go down. No. No. We'll go over that in just a second, okay? Let's go over a couple of the itemized deduction things. The charities, charities have been kind of concerned because if people were taking deductions because they could itemize and now it's 24/4, they may not give, is what the thought was. And that could be true. I don't know. We'll probably see in the next few years some statistics more on that. Most people felt like if you had a passion for a group, whether it was religious or not-for-profit, you continue to give. It wasn't based on some kind of deduction you were receiving. Itemized deductions for planned gifts, which we also do at the foundation. And it repealed something that if you were kind of self-employed or not self-employed, but if you were a W-2 but you had expenses related to your job, they were called miscellaneous deductions. Those were usually the most ones, subject to a 2% floor. They did away with those. Those went bye-bye in 2018 and are not there in 2019. On home mortgage, they didn't want to allow you to go borrow against your house. You got to have some kind of acquisition indebtedness that they're looking at, and not just equity and indebtedness to deduct the home mortgage interest. So really there's supposed to be a pro rata. If you just, okay, I need to go pay for my child's college and you borrowed, or I'm going to buy my car and borrow on my house, that part that you borrowed for that can no longer be deducted as an itemized deduction. So they repealed casualty and theft, except if it's an emergency. So you see why we're claiming presidential emergencies when we have our hurricanes. This one I want you to add because I missed it on my slide. Reinstated at 7% AGI for medical, it's 10% for 2019. So will you write 10% on there for me for 2019? Yes.
One other thing, that 60% is for cash.
Right.
It's different if there are other kind of assets you contribute.
Like stock, there's limits on your AGI. Now, it can carry over what you don't deduct in one year to the next year. Another thing I noticed on I don't know if any of you use this, if you do itemize, but they increased the travel for medical from 18 to 20 cents. It's still not as high as we deduct for other areas, but they did increase that. There's some other things they did with education-related deduction and credits, and the alternative minimum tax was sometimes you don't know you're going to get hit with that. They tried to make that where it applied to fewer taxpayers, and that's a very complicated item. And they modified the estate and generation skipping taxes with that change in the law. Are there any questions about the change in the law?
What do you mean by estate and generation skipping?
Well, they modified they have tables. I don't know the tables by heart, but they modified what the tables amounts were on those tables. in relationship to that.
Could you say something about Schedule C income, since the other deductions are gone? Schedule C income and Schedule C deductions, what's involved and not?
Well, why don't you help me? Give me an example.
Can I
Our question is on Schedule C income and deductions. So for ministers, are we looking at ministers?
I'm still seeing out there where folks are taking business deductions on their W-2 income, and they're putting the deductions on Schedule C. You can only deduct your the deductions, as I understand it. You may clarify, I know you're an enrolled agent. You can only deduct the expenses on Schedule C that are related to Schedule C income. Is that correct?
Yes, that's correct. So what I've been seeing, so there used to be a lot of people that basically had three major itemized deductions. They could do their home stuff, the interest. They did charitable, and they did what I refer to as unreimbursed business expense, which typically was mileage, because a lot of them drove and did not get reimbursed for all the driving they did within the scope of their regular employment. To the extent that you don't get reimbursed anymore for that, you can deduct it if you create a side business on your Schedule C that, so you can take the mileage there. But for pastors, it's kind of hard. Well, actually, pastors would be easy, because in some cases I've set up a Schedule C for pastoral services, and he was able to deduct it there. But in order to deduct it on a Schedule C, you probably need some kind of income. So I would be throwing your honorariums and wedding fees and any kind of extra outside stuff that you did outside of your regular W-2, so that you would be able to deduct it. Again, there's significant documentation requirements doing it that way, and you really should consult your tax advisor on that.
Yes, and the question is about when to do Schedule Cs for ministers. So I would say during your regular job at a church, there's not really a way to do it. But if you have honorariums, you do talking or, consulting or some other, you can deduct those expenses on a Schedule C that are allowed for a regular business, because then you would be considered self-employed for that business.
Well, royalties are all the hopes you will.
Right. Right. Are there any other questions about that? I don't know if I did a good job on your thing, but I'll send you an email with the information on the state and generation.
Isn't the government still going after, I know they didn't succeed this past year,
I'm going to comment on that in just a second.
going after the home interest?
Yeah, it wasn't the government going after it, but I'll go over it in just a second. We'll come back to that question about the housing exclusion or home mortgage interest.
Home mortgage interest.
No, we still have home mortgage interest.
They do now, but there's been attempts to eliminate it as a deduction, and they're still after it to eliminate it.
Yeah,
So it should be a consideration before taking out them $500,000 mortgages.
right.
Houses that are being purchased, because the government's going after it, and they're gonna eventually get it.
Right. Well, there's some things on the housing exclusion why you might want to mortgage and pay interest. So we'll look at that in just a second. This is a thing that hits people. Their Social Security could be taxable. So you're going to be drawing out of your retirement, and that money's probably going to be taxable. So when you get to certain, I've got them listed here. They're the next to the last one. It's $32,000 for married jointly. It's $25,000 for single. When you get to those thresholds, any income over that amount, any of the Social Security, up to 85% can be taxable, 50 to 85%. Now, this came about in the 80s when I first started working in public accounting, and it just did not make sense to me. Okay, you've paid into Social Security, you already paid taxes on that money, but you did not pay taxes on the growth. So that's the side that you did not pay taxes on. They can tax you up to 85%. So I've got a couple examples. This is a couple whose income was 24. We don't see a lot of tax exempt interest anymore, but if you did have it, $6,000. So they're at 30, and this is the quick method. You take half of your Social Security. They received $7,200, so you take half of that, which is $3,600. So this is their provisional income. The base is $33,600, so the difference is $1,600. They're still in the range, we'll get to that high range, but they're still in the 50%. So they're going to be taxed on 50% of the amount over $32,000. So $1,600 was over $32,000. They're going to have to pay tax on $800. Yes. So let's look at the ranges. So for single people, it's 25 to 34,000. So in that range, if you're below that range and you're in that range, or you're like on the line of that range, you know, maybe you're over the 34, but some of it's still under that 34, you might be a blended rate of 50%, and then the amount over is 85. If you're married, it goes from 34 to 44,000. So I've got an example. I put a calculator on here. Did it show up this time? I thought I had a calculator. It was a Motley one. I don't see it on here. I thought I had inserted it, but there are some calculators out. Last year people asked questions, and it's a little complicated, but I wanted to go through. So 44,000 is the maximum. These people with their provisional income, it's 53,600, and 44 is the maximum. So let's subtract that. It's 9,600, and they made 7,200. So all of it's going to be taxable, 85%. Let's say it was lower, it was 48,000. Then it would have been 4,000 over 44,000. That would have been at 85%. And then there would have been 3,200, you see that, at 50%. So there are schedules to do that, and you would have had to add it together. This is out of the Master Tax Guide trying to do it. But in your head, start with your income, add 50% of your Social Security, and see if you're over those ranges. 25 to, is it 25? 32 to 44 and 25 to 34.
Only looking at Social Security, so if you have one person that's on Social Security and one person that's working,
Right.
are you only, for this part, are you only looking at the Social Security income?
You're looking at all your income. So this, I tell my husband he needs to divorce me every December because he's retired. So I make all of his Social Security taxable at 85%. He doesn't have a choice because I'm still working. And because I'm working, I'm in a higher tax bracket than he would be if he was single and lower. Because when you're retired, your income's going to be less probably than you're working. So that's the thing about one spouse working and one person being retired. You have to think about that. Are there any questions on the Social Security? Yes, comment.
Comment. So Social Security is going to show up as a 1099 SSA when you actually start taking it. You can arrange with Social Security to have them withhold tax for you. So that might soften the blow if you end up in this 85%.
So the comment was, No withholding is taken out of Social Security normally. I'm going to show you in a second the form that you use, but you can request to have withholding taken out of Social Security, and they will subtract it, and it will be shown on that SSA. That was a comment, so everyone will know.
You indicated that was gross or adjusted income?
It's the provisional income, it's the gross, it's not subtracting the deductions.
So it's the gross income.
It's the adjusted gross or a provisional. You have to add back things that are not taxable, like tax-free interest income. There's some things you have to add back to it in that formula that you don't have on your tax return. But for most of it, it would just probably be tax-free dividends or interest income. This is what makes you unique, your housing exclusion in retirement. And just to comment on it, and you've pretty much, John went on it, so I know you've already heard about it, but a portion of your pension income can be designating for housing allowance by your church or denominations fund board, and it's pretty much done every year at annual conference, and it's not a dollar amount.
It's 100%.
Right. There's no dollar amount in it. It just says 100%. And the clergy person has no relationship with the local church and will rely on the fund of the pension. That's what it's saying. It's saying that the pension, part of the pension that's been paid in has also been part of your housing, is basically what it's saying, is the past services in the pension by the church or the denomination has been for housing. So let's kind of go through for this. In most cases, you could designate all of your amount. They say 100%, so there's no actual dollar amount. Richard?
Can you go back to the last slide, Pam? You're retired. Let's use Jim Harnish because he spoke to this yesterday. He's retired, eligible. He's going to take his housing exclusion, but then he's asked to go back in. Now he has a relationship with a local church because he's filling in for 4 months. I mean, the way I read that, no relationship with a local church, so that would make him ineligible.
I don't think that's the case. I think he would be, I think there's some probably rules for part-time. I had thought about that earlier, Richard, and I don't know the exact answer. When you were talking, I began to think about that because a lot of my clergy friends have left, they've retired, and then they take part-time appointments after retirement. So the question is, what happens in part-time retirement? Are you still, all of the ones I've worked on, it was subtracted from the pension side. But I assume if the pension wasn't enough, you could also go against the salary from the local church, even though it's part-time.
Would you be eligible to claim the exclusion?
I think you would be. I think you would be. Someone else had a question or comment. All right, so let's look at, I consulted with some of the tax accountants that do ministers to see what they do. On our website at the conference, there are some forms to help you with the calculations, so I've put that reference up there. They do that every year at annual conference. Like I said, we reiterated the 100%. And this happened, I don't know if you know how this came about a little bit, but in 1903 is when we had the Tax Act enacted. And it took until 1921. They had always allowed housing for people that were, required to have housing at their jobs. But in 1921 is when it became an act to allow ministers to exclude their housing. And at that time, a lot of denominations did not have the parsonages like they do today, or even the monies. But that's how we got started. And then in 1954, there was a change in the law. And then in 2002 is when these limitations came in. So it's either the amount designated, well, we have 100% in retirement, Amount of your actual expenses, that's where the forms will help you. It'll list out the expenses you can deduct, or the fair rental value of the property. So that's the lesser of those $3 amounts. The 100% is not going to cause you an issue. The rental value and your actual expenses are. So this brings up the question you asked, should I purchase or should I rent? It's still a personal question, but if you rented, you would know that that's the fair rental value, and you would be deducting, let's say you paid $2,000 a month, you would have documentation for that, and you would be deducting the $24,000. And I think you can add the utilities to that too. So you would add the utilities to that. Question?
Yeah, if you have a home equity line that you have been using for home improvements, can you deduct those payments and interest as part of your?
Yes. Now you have to be careful on home equity when it's not, going back into the home. So, and there are certain dates that cover it also with this new enactment of the law. So you got to check that out before you just say, I'm going to deduct the mortgage. So if you're going to go back to your expenses or fair rental, go back to that form to help assist you to know what you can deduct. And then what the tax accountant suggests to me, this is just an example. This would be your 1099-R from Westpath. I just did 15,000. I got the new form. So let's just look at this one. The housing allowance was designated at 15. We don't have that. We have 100% in retirement. But sometimes with the churches, they tell you annually they designate, or the entities, we do that for the ministers on our staff. We annually designate how much is the housing. And then the actual expenses were 13. The fair rental was 14. You can only deduct the 13, the actual expenses. So if you were receiving the cash, in this case, this is a 1099-R, only 2,000 of your retirement would be taxable. So here again, when you're looking at Social Security, you've got to do the subtraction first to determine what's income. You wouldn't put the 15,000 down as your income. You would subtract the housing allowance to get down to the 2. So on the forms, I got the 2019 form and tried to show you where it goes. It would be on 4A. You would show the 15,000 from the 1099-R. You would show the 2,000 for your income. And then this is what most of the accountants suggest doing. Sometimes I've seen it where they don't list all the expenses, but they lay it all out. So at the end of the day, all the information is there for the IRS on your tax return. What's the fair rental value? What was the pension amount that was allowed and what was received? And then what were your actual deductions? And it gets back to the 2,000 that's on the page 1.
And talk about the first. So when your expenses exceed the amount that is allowed.
When your expenses, the question is when your expenses exceed the amount that are allowable.
Well, that's,
So like your fair rental is 14,000, but your expenses were 15, so you're only going to be able to take 14. You just lose that other part as being deducted, in this case in retirement, from your income.
in this model on the screen, is that fair rental value including the rental value of furnishings?
Yeah, it would be all-inclusive. It's not specified. That's why you should really go to those forms out there on the website of the conference so you get the listing of what you need, because it would include also the utilities. When you're comparing fair rental, you're going to have the rent plus the utilities and the items that you could deduct compared to your actual expenses. So you can see, back to your question, do you want to purchase or you want to rent? It is a personal at the end. With purchase, you've got to think about your taxes and your interest. The interest rates are fairly low, but then are you going to have enough, as you pay it down, is there going to be enough to deduct? Can you think of some other issues with purchasing? You have an asset at the end when you purchase that you can sell and use that money in retirement. But then you have the upkeep. You have that capital expenditure. When you rent, you know what your costs are, and it's really a personal preference at the end of the day, wouldn't you say, John?
Yeah, equity, of course, equity, potential appreciation could also have to sell. It may not be the same valuation as it was before. So there's pluses and minuses to both sides.
Right. So, selling a home and then starting to rent, that gives you money in retirement that you could use to live off of. Homes do cost money for upkeep, so you do have the issue there. But at the end of the day, I think you have to look at your numbers and then your advice, and then it's a personal preference, really. Let me see. This is back to the court case I wanted to bring up. So the court case occurred in the 7th, it was in Western District of Wisconsin, and they ruled in favor of the Freedom for Religion Foundation. But it was appealed. And when it was appealed, I don't know if this is clear, but I put it up. When it was appealed, the 7th Circuit decision was 3-0 in favor of the ministers. So the Freedom from Religion lost their case. I went on their website and looked, and their disclosure was they were not going to pursue it at this time further. I think they're concerned about the Supreme Court, the conservative Supreme Court, and so they are not pursuing it at this time. This is the second time it's been pursued in the same area, trying to determine. The problem is when I went back and started reading about when we went this way in 1921, they didn't really tell why they constitutionally allowed ministers to be different. It would have been nice if they had put that in initially in this 107, but it's not there. So right now we're off the hook, and I think we're going to be off the hook for a while. All right, so that was a question I thought someone might have. Withholding, here's the form for Social Security. It's W4V. One of the things about withholding is if you do it like in December, it covers the whole year. You can do withholding anytime, and it's like the whole year. Where tax payments are specific dates. So if you get into a penalty, they consider withholding for the whole year. And if it's seasonal, there may be ways. There's a form to do for penalties that you can seasonalize. Say you retired in December, but your income, was different. So if you do the estimated tax payments, which some of you may do, it's April 15th, June 15th, September 15th. Sometimes it's a day or two different, and January 15th. Withholding comes out ratably usually, but you can also ask for withholding at a specific time. You can increase the dollar amount. For the 403Bs and the pensions, it's a W4P if you want it to be withheld from the West Path. So you have to fill that out, and they can also start taking it out. So what you have to think about large withdrawals from pensions, what do you have to think about? You have to think about paying taxes on it. And John pretty much covered that, but you may think, well, it'd be better to take it out and pay off debts. But you may lose some of it. So you really have, there again, that's why I think you need to go through your list of your circumstances. Should you pay off the home mortgage? Well, then you're not going to be able to deduct the interest for the housing allowance. So you have to think about those things when you're doing it. Remodeling a house. There may be times when it's better to do a large withdrawal. Your income is down. Maybe you've deferred Social Security for a while. And so some people defer Social Security and they take it out of their retirement. And so it's down in those years, and then they reduce the retirement in later years. One of the things that did happen with this new act is that moving expenses are no longer allowed as a deduction. So you all know that for 2018 and 2019.
Go back to that slide.
Sure.
It says, the largest component of housing exclusion is lost when the mortgage is paid off.
Yes.
And then the next one says, didn't you address home equity loans earlier?
Yes, yes.
And so that the points or the interest on home equity is not deductible, but home equity can be used as in computing housing exclusion if the loan is for housing related. So if you were to take a loan on the equity of your home for repairs or
Right.
expansion, then you would be eligible for housing exclusion. Otherwise, you wouldn't. Is that what I'm reading?
That's correct.
Okay.
So you can't get a HELOC or a home equity line of credit. You know, what some folks have done, I think mistakenly, is they pay off their house and then they'll go get a home equity line of credit and then try to use that against the housing exclusion. You can if what you're spending is related to housing costs. I believe the way the tax code reads is it has to be acquisition debt. So it's either your initial mortgage to purchase the home, or if you have a HELOC, it has to be, as Pam has up there, it has to be for expenses that are related to the home.
Repairs or upgrades or?
That's correct. That's correct. But you can't go take a trip somewhere with that money. That doesn't fall.
There's a question?
Yes, we're that long-term care part of it.
Long-term care?
Yeah, they talked about taking like you make a lump sum payment for a one-time deal with the long-term care, that sort of like an annuity for that. Would that be something like if you were to take part of your withdrawal from pension for that? Would that be taxable like as if it was income, just like?
Yeah, I think it would be, but then you probably would get an itemized deduction. I don't know how much it would be, you'd have to look at the law, but I think for long-term care, then you pay the insurance. If it was like an insurance product, and it was considered a medical deduction. So you would have it over 10% of your adjusted gross income could be used to itemize. Do you agree with that, John?
Yeah, it's a taxable distribution.
It would be taxable distribution, but you may have
Potentially offset. Yeah.
potential partial offset, because not at least 10% of your AGI. And that would depend, it might make your AGI higher, the 10% might be higher than you even paid in the lump sum payment for long-term care.
So comments, just, if you do that and you end up deducting it as medical, it doesn't carry forward. So it's gone the year you use it. The deduction is gone. So that's the kind of the downside of having a big long-term care payment. Because I had that with a fellow that paid his level 3 long-term care.
Is there anything you can do to offset the taxes on that distribution then? Let's say you took a large distribution, get one of these.
Well, yeah, because you're going to get the big deduction.
Okay, my time is up. Thank you. I've got some other sources. Feel free to call me. I'm at extension 7110 if you call the conference number. And my name is Pam Hicks. Thank you.